Welcome back to the Wealth Honesty Podcast. Today, we're very excited to have Kevin Kimbrough with us. He's Executive Director of Fiduciary Insurance Services with Pinnacle, and he's going to go into more what that means to you as a client and what that means to all of us. But we're excited to have him. Kevin and I go back several years. We worked together in past parts of our career. He's always done a fantastic job. You're going to find him very thoughtful, eloquent, and as he speaks about the value of looking at policies, reviewing them from time to time, auditing them, and treating them as assets.
Yeah, I'm excited too. I mean, he's got a wealth of knowledge. I think he's over 30 years in the business, right? Or more than that.
Yeah.
So I'm just really excited for this episode. So Kevin, thanks for coming on today. Glad to have you. Want to tell us a little bit about yourself and your role and a little bit more about what you do?
Sure. I'm Executive Director of Fiduciary Insurance Solutions with the Pinnacle Group. With that, I partner with registered investment advisors, their investment advisor representatives, and their clients to help them in prudent selection and implementation of insurance products. And we do that from a fiduciary perspective, which means that we're always putting the client's best interests at the first and foremost of all that we do and all that we're trying to solve for.
That's amazing. So how long have you been in the industry?
Believe it or not, about 33 years now. So pretty much all of my professional life, I've been some form or fashion in financial services, almost always focused on insurance, annuities, and long-term care.
Very nice. And how did you get into that?
Graduated from University of Arkansas with a degree in finance, and had some friends that had gone into the insurance business, and they said, we think this would be good for you, and walked right into it, and turned out to be a really good fit. So that's where I've been all of my life, and have really enjoyed it, and enjoyed partnering with a myriad of different financial advisors and helping a lot of different clients along the way.
So I had a question for you, Kevin. And by the way, Kevin and I have gone back now about 4 or 5 years working together.
Yep.
He used to be my boss and had a former opportunity. And he always did a fantastic job. So I was grateful to reconnect with you.
Absolutely.
You know, for our clients and the folks that might be listening to this, can you go a little more depth about what extra steps a fiduciary might take in helping people make decisions about their insurance coverage?
Yeah, I think it's just taking the time and the effort to drill a little bit deeper into the specific details of really what's in the best interest of that client, looking beyond sometimes even the cheapest product to find the product that is most suitable based on what the long-term goals and objectives are of the client. So it's a little bit more than just a surface level decision. And it certainly involves always putting aside the financial advisors or the insurance specialist interest at all into the decision making and the process that we use to evaluate what would be in a client's best interest.
Okay. So on that, tell me a little bit about that, like those conversations that you have when maybe a client sees certain pricing, or they think that that's pretty, I could probably afford that, or that's cheaper than I expected, and then you have other products that are going to be a better fit. How do you go about those conversations with people? And tell us a little bit more from the client's point of view, how sometimes looking past the cheapest option is going to be a better option.
Yeah, that's a great question, Mark. I think probably one very simple example is when you look at something as basic as simple term insurance. When you're looking at life insurance, a lot of times you can go online to a lot of these quick price, cheap term insurance quoting engines, and they will give you who has the lowest premium. The things that are behind that you don't always see, probably one of the most important are the conversion options. What do you have down the road if you're buying a 10-year, 15-year, 20-year term policy in terms of what you can convert that policy to? Should you need to maintain that policy for a longer duration than for the duration that you bought the term policy for? So, for example, if you're buying a 20-year term policy, a lot of the times the lowest priced options will only be convertible for the first 10 years, meaning if you wanted to take that policy and be able to move to a permanent policy without having to go through underwriting again. Maybe your health has changed. You've had a deterioration in your health. You've developed some medical conditions that you didn't have when you initially took out the policy. If that policy is only convertible for the first 10 years and you decide to convert it in year 13 or 14 or sometime before year 20 because you had a change in health, You wouldn't be able to do that with one of those limited conversion policies. The second thing that we see is some carriers will actually limit products that you can convert to. So they'll put the best and most efficient products available for sale on the shelf to the public that's going to go through full underwriting. But if you're having to do it under a guaranteed conversion option through a term policy, well, then they'll only limit your products that you can convert to the higher priced, less efficient products. So we try to stay away from those when we're looking at term policies, especially with longer durations out to 15, 20 years or longer, because we want somebody to have a policy that they can convert for the duration that they have. In the event that they do have that change in health and need to maintain that coverage, we want them to be able to get coverage under the guaranteed insurability options that a conversion allows, and also be able to get to the most efficiently priced product that's available for the carrier that they're working with. So we try to stay in that vein. So a lot of times in that vein, we wouldn't be dealing with the lowest price option on the spreadsheet, but we would be doing what's in the client's best interest.
So then that's a lot deeper dive into, all that fine print that, just the online price quote is not going to give you. It's just going to tell you price and that's it, right?
That's exactly correct, Mark. Yeah, a lot of times you run those quick numbers and it will tell you who's cheapest, but it doesn't give you those details behind it exactly.
Okay.
Have you had any experience converting term insurance for people that maybe their health has changed? And if you have, could you describe how that worked out for them?
Yeah, certainly done it a number of times where somebody has had a deterioration in their health. They realize they do need to maintain that policy because they're maybe going to need insurance longer than what they anticipated when they took that coverage out, and they now know that they can't turn around and go reapply for a new policy because either they're going to be rated, charge an additional premium because of their change in health, or perhaps even declined and not able to get new insurance.
Right.
So given that, I have had the experience where we've been able to say, hey, because you've got a policy that's fully convertible, we're able to just complete the forms, run the new illustrations. It is at your new age, so if it's 5, 6, 7, 10 years down the road, it's going to be based on your age at the time. And we're converting to a permanent policy instead of a term policy. So there's going to be an additional cost involved, but you're not going to have that rating because of a health change, or perhaps have the inability to get a policy because of a health change.
Right.
So I've done that a number of times where people have developed serious health concerns, and we were able to say, okay, we're going to get something that's going to be able to be in place for sure and not be excluded from that. So on into the day you die, you're going to have a policy in place.
So something they couldn't have done in the new situation. Completely impossible.
Completely impossible. Yeah, he would have been precluded completely from being able to get insurance.
And that includes like accidents too. Like if somebody got into a car accident and became disabled, would that make them potentially uninsurable?
Certainly, yeah. You certainly have some health issues that could come out of an accident situation that would mean, you're not going to be able to qualify for a new policy. So being able to convert would step in that situation too.
Lots of really important things to think about when you're making a decision, instead of just going straight to the cheapest. That's the one I'm going to grab. If they can do me right now on the spot insurance, there's a lot more to think about than that.
Yeah, a lot more to think about that. And that is a great point on the accidents. I mean, even things too, like sometimes people develop hobbies or avocations later in life. Maybe they decide to start scuba diving or skydiving or motorcycle racing. All of those sort of things are things that an insurance company takes into account. And if you weren't doing those things when you were applying for the term insurance and you have a guaranteed convertible policy, you can convert without respect to the same thing with foreign travel issues, Mark. If somebody was, not expecting to be traveling or working in an international location that may be a dangerous location, maybe due to their occupation or church activities or what have you, they're going to an area that maybe wouldn't be as stable, and an insurance company would not necessarily want to insure somebody in that situation. If you've got a guaranteed convertibility on your policy, they're not going to be asking those questions about new hobbies or foreign travel and those sorts of things.
So that kind of brings up an interesting thought. I know that you've been involved in many missions and so forth. What advice would you give to people that may be considering missions in the future? Nothing concrete, but possible missions in the future. What would you advise them? Especially maybe they want to go to Africa, or they want to go someplace that, like you mentioned, may not be as safe as what we enjoy here in the United States.
Yeah.
What would you suggest to them before they have actual plans?
I think that's the key, Kurt, is go ahead and get the insurance in place now, because you can answer the question on the application we don't have any plans. We don't have tickets in hand. We don't have dates on the calendar that are circled that we know we're going, but it could happen. So let's go ahead and get the insurance.
Good life goals.
To answer that question, no, we don't have plans to go. But if those plans change in the future, you've got the insurance in place, you're in good shape.
Right.
Nice.
Okay, perfect. And so I think you're really highlighting the value of reviewing the insurance. I mean, I think most people, they buy an insurance policy and then they put it out of their minds. It's in the drawer and they forget they have it until something happens.
Very common. Something that I like to say is oftentimes it's the largest, most neglected and often overlooked asset of a client's balance sheet. Usually they buy a permanent insurance policy and they take that mode of, maybe you've heard the phraseology of set it and forget it. I bought the policy's in place, I can just put it in the drawer and forget about it. And that's like any other asset that you have. It needs to be reviewed on a regular basis and looked at because things can change. Things can change with the insurance company that you bought it from, whether it's their financial condition, their financial strength. Things can change with the economic environment that could affect the internal performance of the policy. Things can change also with the costs, the fees and expenses. I like to say we need to do CPR on your policy. We need to look at the costs, we need to analyze the performance, and we need to assess the risk. So COER, most performance and risk. We want to see how the costs are in that policy that you bought maybe 5 years ago. Are they still the same? Because those internal charges can change sometimes. How's the performance? Is the interest rate assumptions that we were using when the policy was purchased, are those still the same, or have interest rates gone down? Or if it's an indexed or a variable investment-based product, how those investments been performing? What's the performance of that, and what are the implications of that? And then the risk. Some insurance companies, when you buy a policy, they're in great shape, and things happen over time. They maybe had a deterioration in their financial condition, and you may want to say, we may need to move the money that we have in one policy to a new policy with a new carrier that doesn't have any questions or concerns around their financial strength.
Yeah, that's awesome. Good question for a lot of our viewers. Let's say I have an insurance policy. How often should I be looking at that? Is that like every year, every 5 years, or what is there like a specific time, or when I have a child, or?
If you're working with a financial advisor that's doing an annual review, or usually they're sometimes doing semi-annual or even quarterly reviews, maybe not need to look at insurance quite that often, at least every 2 years. But if you want to really dial in and fine tune your financial plan, it's an important consideration in your overall plan. So looking at it even once a year is a good idea.
So tell us some of the experiences you've had as you've audited policies and looked at them. What are the situations you found? How have you been able to improve? And I'm sure there's been times when you haven't been able to improve. Can you highlight some of those and tell us about that?
Yeah, certainly. There's definitely that situation where you can tell a client you're in good shape. You've done good planning. You selected a good policy with a good company. And we actually use some tools and resources that we have behind the scenes that we use to do those analysis of those existing policies. And I just did some last week. We're using the star rating system that we use and benchmarking those policies. I was able to tell the clients, out of 5 stars, your policies are 4.5. That's pretty darn good. You've done well. You purchased from a good company. Your policies have performed well. The costs are right aligned with what you expected. So you're in good shape. At the same time, we see a lot of times, and usually if I look at 10 policies, Kurt, it's probably going to be about 4 out of those 10. We're going to see that clients are actually being overcharged within those policies. And there's something that we can do to improve their situation. And when I say overcharged, a lot of times I just like to start to ask the question, begin the conversation with someone thinking about a permanent policy that they purchased maybe 5, 10, 15 years ago, and say, do you know what you're being charged? And a lot of times clients don't know what they're being charged. They'll say, I know what my premium is, but I don't know what I'm being charged, because the important thing is the internal charges that are embedded within the policy. Those charges are separate and aside from what your actual premium dollars are that you're writing the check for every year. So looking at under the hood, so to speak, at how that policy is performing and what the charges are doing, and we actually can benchmark those charges against, if we're using, for example, someone in my age group, a 56-year-old male, and let's say I had a $3 million permanent policy, whether it's a whole life or a universal life or a variable universal life, we're going to look at that particular type of policy for a 56-year-old male and say, okay, based on that, what are the best available rates and terms that are available in the universe of all insurance policies for a 56-year-old male, for a whole life or variable policy, whatever type of policy they have? What are the best available rates and terms? What are the worst available rates and terms? And then where does your policy fall along that spectrum? And then we can tell, can we save you money internally on those charges? And if we can, the implications are that you can pay less premiums, or maybe you can get more death benefit a lot of times for the same premiums you're paying, or add additional benefits like things maybe that weren't available when you purchase that policy, like long-term care rider, which is very nice to be able to add to a policy that you've had in place 10, 15 years, and you didn't necessarily think about long-term care planning. And maybe the long-term care riders on a life insurance policy weren't as prevalent back then, but now you can add that sometimes for no cost at all compared to what the premiums are that you're paying for your existing insurance.
Yeah. Actually, I found that strategy to be very helpful for clients because as they get older, 56 maybe being a good example, you may have bought your policy when you're 40. There was no thought about long-term care issues at that time. Now at 56, you're seeing the results or the practical effects of people needing long-term care. You're thinking, man, it'd be great if I could, put that benefit on my policy without creating a whole lot more expense. And tell me about a situation where you've seen where that's happened.
I was just working on a policy for my favorite client this morning.
Okay.
Literally this morning. Okay. My favorite client is my wife.
Oh.
She has exactly that scenario, and actually I'm going to do the same thing with my policy, but she has a policy that we bought back in 2002. So, we're looking at, 20 plus years ago now, and we didn't have any long-term care benefits to it. Also, the insurer is not as strong financially as they were when we purchased it. Okay. And we're able to get better rates and terms within the policy. So I was able to get her, she had a $400,000 policy. I was able to take her to a $600,000 policy and add a long-term care rider that's a 4% rider of that $600,000.
Wow, that's excellent.
It's 4% of that $600,000 to use
On a monthly basis.
Yeah, on a monthly basis for a long-term care need. And it's particularly important, Kirk, because personally know some of my story. I've just last year moved my mother-in-law, my wife's mother, moved in with us because she's not able to take care of herself.
Right.
And unfortunately, they didn't have long-term care insurance, and we don't have the ability to draw on a long-term care benefit to take care of her. And knowing that there's that history, it also was the same health history with my wife's grandmother. My mother-in-law's mother had a history of dementia in this case, and it shows that, okay, yeah, we should definitely do that type of planning for my wife. And doing a policy review for my wife, we were able to move her cash values from her existing policy into a new policy, increase the death benefit, and get that long-term care benefit, and not increasing her premium payments at all.
That's a huge win.
That's incredible. That is 20 years after she got the original one. So, you would think, or most people would think, the premium is going to go up or something like that, but these products have improved that much over the last 20 years.
Yeah, the products have improved, and what's helping keep everything stable or static on the premium level is the fact that we are taking that cash value that's in the policy that she has, and we're transferring it over something called a 1035 exchange. And 1035 is a reference to the Internal Revenue Code that says we're able to do that exchange on a tax-free basis. So if there's gains in that cash value we're moving over, we don't have to pay any taxes on those gains. It transfers as tax-free exchange to a new policy. So she's able to do a tax-free exchange, transfer all those cash values over, and because the cash values go into the new policy, the premiums are the same as what she had on the previous policy.
That's incredible.
And I guess even though we're not tax experts here, we're all pretty aware that long-term care benefits are paid out typically on a tax-free basis.
That's right.
So it's a way of, again, leveraging that money and doing more than a death benefit.
Yeah, the tax efficiency of insurance, the life insurance, the long-term care benefits. Yeah, it's definitely one of the things that tips the scales in terms of life insurance being really an efficient planning vehicle.
Right.
The tax payability of it is usually so bad.
Let's talk a little bit about those. What are some of the ways that people could benefit as far as their taxes and stuff? Let's just talk. So somebody that doesn't know anything about insurance, or they're thinking about maybe, I may have some term, and I'm thinking about getting some whole life now. I'm getting a little older. I might have kids, or I just got married. I want to get a little more serious about my insurance situation. What are some additional tax benefits that we could talk about so that our viewers can hear a little bit about that?
Yeah, great question, Mark. Probably the biggest thing is always to remember that a death benefit of a life insurance policy, as long as it's properly structured and known, is going to be income tax free to your beneficiaries. So one of the things I like to do, and Kurt, I know you do this too, is, if we just look out to our life expectancy and say, if I live to the age that I'm expected to, based on a 56-year-old male in reasonable health, I should live to be, it's probably, in the mid to upper 80s or something like that. But we can actually calculate the internal rate of return on the death benefit, that benefit that's going to be going back to my heirs, my children, my grandchildren, maybe a charity, my church, or something that I want to benefit from that. That's going to be going on a tax-free basis to them. So when you look at that internal rate of return, when we do a tax equivalent exchange, you can see that it actually a lot of times will outperform many other investments that a client could be using to transfer assets to their children or grandchildren or charities or something that they want to benefit from their estate. So that's significant. Kurt brought up the fact that the long-term care benefits up to the IRS limit, which goes up every year. It's about $15,750 a year that you can use towards long-term care benefits out of a long-term care policy or life insurance policy with a rider that are tax-free. And then that goes up every year too, that you can take out tax-free.
And that's the premiums you're paying for those that are tax deductible from your taxes. Is that correct? Or
you're usually with the life insurance policy not taking the tax deduction, but if you're buying standalone long-term care, you can get some tax deductibility. And in some cases, the hybrid life insurance policies, which is getting a little technical, but there are certain types of life insurance policies with the rider where you can deduct a portion of that. That depends on how old the client is and what their tax situation is at that particular point in time. But there are some potential tax deductions depending on the particular type of policy you buy and what age you are.
Very good. So he was talking about a tax-free distribution from the death benefit.
for the death benefit?
Should be used for long-term care purposes. Yeah. So we do a transaction, and it's in the client's best interest. But typically, there's some kind of a cost involved in doing any kind of transaction. And of course, what you've talked about also so far has highlighted the fact that life insurance is an asset and should be managed like any other asset. What typically are the costs that might be involved in doing an exchange, a 1035 exchange?
Yeah, certainly there are transaction fees, expenses, and everything that are involved in that transaction. But when we look at those and we compare the result of what a client has versus what they're going to end up with, that's always netted out in the long run. Usually, if it's a short-term need, probably an exchange is not going to be the most efficient way to go. But most of the time, if you're dealing with life insurance, you're expecting this contract's going to be in place for a long period of time, 10, 15 years or longer to life expectancy usually is what you're anticipating. And over that period of time, the costs of doing that exchange, of doing that transaction are going to be amortized, if you will, over the life of that contract or the life of that insured. And we net that out to say, at the end of the day, is this a better net transaction for the client? Are they coming out in a better situation than they were before?
There's really no out-of-pocket cost in that kind of transaction.
There's usually no out-of-pocket cost. Some advisors will charge a fee for doing the type of work we do, but we don't do that. But in terms of a client having to come out of pocket with something, usually not the case, because we're usually just using those internal cash values they have in an existing policy and the premiums they're already paying, unless they're trying to really increase coverage due to some additional need that they didn't have when they took out the original policy. Okay. The other thing, Kurt, I'll mention, it's very important in terms of just doing reviews, is not only looking at those things in terms of cost, performance, and risk, but how is your policy set up today? How is it structured? How is it owned? Who are the beneficiaries? In light of all maybe the estate planning that you've done since you purchased your policy that wasn't in place when you purchased the policy, now you've maybe gotten trusts in place or a different planning, and you need to review your policy in light of that planning that you've done. So it's always important to take care of and looking at things in light of estate planning you've done. Any changes that you've had,
life events, or
I'm sorry.
Like a life event, like I just got married, or I got have another kids, or something like that.
Big changes in your life. I've seen situations, unfortunately, where people have gone through a divorce and they still have an ex-spouse named as the beneficiary. And then I've seen situations too where circumstances or tax laws have changed since they purchased their policy, and the way they have it structured once it is beneficial. I saw one where the policy was intentionally owned by a trust to have it outside of the insured's taxable estate, but it was an individual policy on the insured, and they had named his wife as the beneficiary as opposed to naming a trust so that the assets would stay outside of the taxable estate. So what that would mean would be when the insured died, the benefit is paid tax-free to his wife. Unfortunately, now it becomes an asset that is within her taxable estate that, if they're subject to the estate tax, would be part of their taxable estate. So changing that beneficiary designation to a trust that would still leave the benefit for her to access in terms of her health, education, maintenance, support. She has access to the income and the assets in the trust, but it stays outside of her taxable estate. So it's not includable for estate tax assessment. So doing things like that, just doing a review to look at how your policy is structured, can be critically helpful and important too.
So what else should we be talking about as far as reviewing policies or analyzing policies? What's been some of the cases you've worked on that have maybe some of the more sophisticated cases? Can you describe some of those?
Yeah, certainly have seen over the last maybe 10 to 15 years ago, there's been some complex planning strategies that have involved people taking out policies, utilizing a loan to pay for the policies using what's called premium finance. Those were done based on the interest rate assumptions at the time, and the interest rate assumptions not only affect the loan that they took out to pay the premiums, but they may affect also the performance within the policy. And so we're looking at policies now that were purchased on a premium finance basis maybe 15 or 10 plus years ago, and those circumstances have changed, and a client's trying to assess how do they rectify the situation now, because we thought we were going to be paying X on the loan, and now we're paying X plus some additional amount, and we thought we were going to be earning Y on the policy, and maybe we're earning Y minus some amount, and the two things have gone opposite directions of what we wanted it to. What can we do to rectify that? And you've seen by doing a review sometimes of those internal costs, charges, and fees in the policies, we're able to find cost savings to unwind those unfortunate circumstances where people may have been in a premium finance scenario that has gone wrong.
Okay, that's excellent.
I think it is one of those conversations you just want to have on a consistent basis. It's important in every level of planning. When you think about your legacy, when you think about your survivor needs, if somebody's the breadwinner for the family and their income goes away due to a death. And then you think about things where you have a death in the family of a close loved one, and you have an adjustment period. If you lose a spouse, if you lose a child, or somebody very close to you, what's that going to do to your ability to work or run a business or to maintain your life? Are you going to need some adjustment period to reconfigure your lifestyle, get back on your feet? And people don't always think about those things too. And that even brings up, the need to sometimes do you need to have life insurance on children? And I always encourage people to think about that. Not only do you have the final expense costs when someone passes away, but if you lose a child, there's probably going to be a pretty big adjustment period in your life, and you might want to think about those sort of things too. So factoring all of those variables in can make for planning that takes away a lot of uncertainty that can come down the road.
I mean, this whole process is it's a lot deeper than just going onto a website and, go on Google, check out the cheapest insurance possible, click, I got insurance, I'm good to go. There's a lot more like thinking and planning and situational awareness, I guess, that would require the expertise of experienced life insurance professional that could kind of go into that. Any thoughts on that? Or
Yeah, absolutely. I mean, it's one of the things that my constituency, the people that I call on every day that I try to partner with, are the typical financial advisors. And those financial advisors are usually really, really good. at managing a client's assets, helping them get the most out of their investments and getting, the highest return that they can on those investments for the least amount of risk in the most tax efficient way. And that's a very, very critical skill that you need from your financial advisor. But financial planning goes well beyond that too, and touches every area of your financial life, into areas where a lot of financial advisors, their core competency maybe is around that investment management stuff, around taxes and that sort of thing. And they're not as adept when it comes to insurance planning, life insurance planning, long-term care planning, or even using an insurance product like an annuity that's designed to guarantee income for somebody's life, which is something that's becoming more and more important as we see people living longer and longer with the advent of genomics and gene editing and AI and quantum computing. The advances in healthcare that we're seeing could really extend people's longevity, meaning they're going to live a lot longer than they ever planned for their assets. So looking at all of these factors for a financial advisor to think about longevity, to think about long-term care issues. Now, boy, we've got a client that's going to be living much longer than we anticipated. What are we going to do for care for that? And then what are we going to do from the life insurance planning standpoint? And a lot of those things are what I call the soft side of planning. In one of the courses that I had having to do with estate planning, it talked about the above the line planning and the below the line planning. And the below the line planning are the things that are typical technical based financial advisors are really good at. Maximizing investment returns, maximizing the tax efficiency of a portfolio, and minimizing risk. All of those things are quantitative, almost sort of left brain things. Those above the line planning things are what I call more the right brain things, the things that appeal to our emotions, our goals, our dreams, our aspirations, our values, our things that are important to us, more of the soft side of planning. And so when I say it's important to think about planning from both below the line and the above the line, I feel like that's part of the area that doing this sort of planning with life insurance, long-term care insurance, and thinking about longevity issues, need for guaranteed income for life using annuities is critically important. So those above the line soft planning discussions are something that are just as critical as those below the line facts, figures, or data sort of planning issues.
I love the way you've termed that, helps define it and helps us understand that. So we've talked about the importance of getting a good term policy that's got conversion opportunities. We've talked about the value of a life insurance as an asset, how it needs to be managed over time, how people can take existing policies and create additional benefits, including long-term care, and the cost behind it. It's been fantastic, a fantastic amount of information that you're helping a lot of people with. So we thank you, Kevin, so much for coming on today. Anything else you want to talk about, Mark?
I just kind of wanted to touch a little bit more on that, seeing life insurance more as an asset than an expense. Can you kind of dive into that a little bit more? Because a lot of people, when they hear insurance, their first reaction is, it's like car insurance. Like you pay. I don't ever want to get in an accident, but if I do, hopefully my car insurance pays. You know what I'm saying? And so people see life insurance sometimes in a bad light or in a certain way because of that. Can you kind of talk about how, like, that different mentality and how this is a property or could potentially be, whether that's whole life, and what the difference between that, like whole life or term, would be as far as like actually being a property for a customer?
I think what at the core of that, Mark, is when you have permanent insurance, it should be the inevitability that if you've got the right type of policy, it's properly structured, properly funded, and managed properly throughout your lifetime. So the importance of, again, doing the annual reviews and keeping up with how the policy is performing, it's going to be there the day you die. People sometimes will ask, well, what is the best type of insurance? Well, if I knew the day you were going to die, I can always answer that question. But none of us have a crystal ball. We do all know one thing, though. We are all going to die, and we just don't know when. So we want to have insurance that's in place on the day that we die. And if we have permanent insurance, we know that that's going to be an asset that transfers on a very tax-efficient basis to our children, to our grandchildren, to charities that are important to us. And probably using that car insurance analogy, another way to think about it is that's different from my mother-in-law's example on her long-term care, using my mother's example. My mother did purchase long-term care, but she purchased long-term care probably 20 years before she died, and she purchased a standalone long-term care policy that wasn't tied to a life insurance policy with a death benefit. So what that meant was she paid premiums, and a lot of those policies, unfortunately, have seen rate increases over the years. She did have some rate increases, but for 20 or so years, she paid into that policy, paid premiums. Now, thankfully, my mother never went to a nursing home, but she passed away. We never used that long-term care benefit, and we never got anything for it. That's why I like the policies today to have a death benefit. So we know your family's going to benefit one way or the other. Either they're going to get the long-term care benefit if you do have a long-term care event, or they're going to get that asset transferred to them. So when you think of life insurance as an asset class, it really is that. We know that that is not an expense that's just money that's paid and you're never seeing anything in return. It's going to benefit your family, either in terms of long-term care if you do have a long-term care rider, or in terms of that legacy transfer to your children, to your grandchildren. So you know that I'm just transferring this money. I'm doing it through a vehicle that's going to give me leverage in terms of the death benefit, particularly if there's an unexpected early death. And then that's also going to do it on a tax-efficient basis. So just it just is transferring money from one pocket to the other, but doing it in the most efficient manner possible.
Permanent insurance is definitely going to be a key for that to be, seen as an asset or a property. And then let's say somebody doesn't have the budget right now. They want to get some of that. They don't have the budget to get a whole bunch of that. What are your suggestions there? What are some strategies for people that are maybe on a budget? I definitely want to get that permanent insurance, but I need at least $500,000 in coverage or $1.5 million in coverage, at least while I'm working. Can you kind of tell us some of those strategies?
Absolutely. And obviously that scenario, you're typically seeing newer, younger families, children at home. They're just earlier in their careers, just getting started. And you do have to start working from the budget and what are the budget constraints and how do we fit this insurance into the budget. And the number one thing that I encourage people in that situation is you have to plan for what the life insurance is intended for, which is taking care of the loved ones if something happens to you in an unexpected time, to replace your income, to pay off debts, to provide for children's college education, to do all the things that you're not going to be there to do. And usually if you're under a budget and you need to do that, term insurance is going to be the most efficient way to do that, to make sure you're getting the proper amount of insurance. And we can walk through that with you in terms of how much insurance do you need to replace your income, to pay off those debts, to provide for college education for children, all those things. We'll just do the calculation and say, this is how much insurance you need. Then we'll look at the budget that you're working with. Maybe we need to use term insurance here for the next few years. And we'll start working with you, your financial plan over the next few years to say, let's start to perhaps maybe convert part of that to permanent insurance as the budget grows with your income growing and you've got a little bit more capacity to buy some permanent insurance down the road. But let's first cover the need for the life insurance for the family, for the children, for the grandchildren, for the spouse.
Now, with that, some people might be wondering which one would be better, get a term policy that I can convert, or would it be good to get some permanent with some term and kind of do like a combo there? What's your suggestion on that?
I always solve for the right amount of death benefit first. Because that's the first and foremost. What's important is we want to know the family's needs are provided for in the event of an unexpected, untimely death. So whatever the budget allows, if the budget only allows term insurance to do that, then that's okay. We'll do term insurance only. If you can do some combination a lot of times is a really good way to start. We're going to put some portion in permanent. We're going to put some portion in term to get us to the full need. And then maybe we'll convert additional parts of that to permanent over the years.
That's awesome. That's good stuff. And now, let's say if I got my kids and I want to set them up with some type of insurance, or I want to just get them set up for life, but I don't really want them to know about this. Obviously, I just want to have their insurance. I'm going to do some whole life on them. And how can they benefit from that whole life policy? When they maybe go to college, or they want to put a down payment on a house, or that's their property that I'm kind of gifting to them as I'm in my working years.
Yeah. That's a great way to do it. You can use a lot of these policies that have an investment base to them. A parent taking out a policy on a child, the parent's going to be the owner of that policy. That ownership can be transitioned to the child when they reach the age of majority, when they're legal adults. But you've got it in place. You're paying the premiums. Something I did for my daughter, and now she's got a policy with a good amount of cash in it that she's taking over. She's in her adult years, and that's something that's in place and going to benefit her for the long run. So it's definitely something good to do, and you have options down the road with how to structure that ownership and when they'll benefit from that.
That's good. And there's a lot of pay options. Like you could pay monthly, you could pay annually, you could pay, there's some that are 10 pay, 20 pay, correct?
Yeah, you can structure the pay if you want to, pay it however it fits best into your budget from the cash flow perspective. And then if you want to do things like, I want to know that I'll be done with these premiums in 10 years and I won't have them in my budget, you can structure it to get everything set up that the policy will be self-supporting based on its returns within the policy after those first 10 years.
That's awesome. A lot of flexibility there for anybody on any budget, whether you're high income earners or you're just starting out and you're trying to get your feet, grounded with this. So that's awesome. You got anything else?
No, thank you so much, Kevin. This has been amazing and excellent. So we appreciate your time and your knowledge and sharing this with us today.
Thank you.
And our audience. So
Thanks, She. Good to be with you.
Wow, that was incredible. What I really love is his focus on the client and their situation. It's not just here, cookie cutter, everybody gets this product, we're just slinging products. He really has a focus and the mentality of finding what is best for every single client situation.
Well, I love the fact that we talked about so many different aspects of the ownership of life insurance, starting off with some term insurance and then making sure that term insurance is with a great company that has great conversion privileges. That's very important. And then looking at how that can impact their decisions later on and allowing them to keep coverage even if health situations or their lives have changed. It's also why I love the fact that by using these policy audits or reviews, we're often able to determine that products have improved, perhaps even life expectancies are longer than they were when they first bought the policy. Therefore, the mortality tables have improved and people are able to do more with their current policies than they have, adding even the benefits such as long-term care benefits, which probably weren't an issue back 20, 30 years ago. So I think we've gone through, kind of the life of a policy in a way.
Yeah, because
how that serves people over the years.
Yeah.
So I'm grateful to see that.
And I really like the part about, where he talked about how often and what we should be looking for when we review policies. Because again, most people just buy, toss it in a drawer. Hey, if I die, open up that drawer. Okay. But that is not the best option for
Right.
most people. You got to be looking at stuff. This is another asset that you're adding to your asset portfolio and your financial situation. So it's something to really, really take a look at those different angles.
Well, thanks, Mark. And for our clients out there, Dynasty Wealth podcast invites you back, and we look forward to great content in the future. And maybe we'll bring Kevin back again someday.
Yeah, and if anybody wants to reach out or find out some more from Kevin, we're going to have his information in the show notes. So we're going to be able to get in touch with him. But appreciate you guys. Our next episode is going to be fire. So tune in next week and we'll go from there.